Hello, listeners. This is part one of a two-part series. Part two will be releasing Friday, April 30th. Enjoy this episode, and we'll see you soon.
Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Folks, joining me today is none other than Eric Fuhrman, our Chief Planning Officer, and we have a really interesting podcast with lots of great statistics today on the issue of concentration risk. Now, before you hit that button to say, oh, I don't need this, I don't have stock, hold on, keep listening, because we've got a lot of really good stuff for you today. Eric, welcome to the show. Thanks
Patti?
for joining me again.
Yeah, great to be here again. You know, there's this magical quality to the podcast studio, and
you bring it.
In here.
You're bringing it.
Yeah, and it's just something about the interaction too. You know,
Yeah.
it just there's a lot of good stuff comes out of these podcasts that we put out here.
You know what, Eric? I'm going to share something with our viewers and our listeners. We do this stuff late at night, and we were working on the podcast for today, and I was really getting excited about some of the things that we were talking about. And I thanked you so much for the amount of work and research you did to put this together today. And you said, well, you get me excited because you really like this stuff as much as I do.
Right.
And there really is a lot to it. And it's really important because, you know, we have a purpose here. The purpose really is to embrace the complexity, to deliver clarity and confidence in all aspects of your financial affairs. So thank you so much for everything you do.
Yeah, no problem. And I think the important thing is there's a positive feedback loop here between the two of us. And I think, you know, the momentum
infectious.
just feeds on one another. But yeah.
Okay, so we're talking about concentration risk. So I think what you wrote here was fascinating.
Yeah.
History highlights that great financial success and financial ruin have one common denominator. What is it, Eric?
Concentration, usually in a single enterprise or investments, and so forth.
Yeah, and you know what? It's so true. We hear so much about, you know, the really, really super rich people who concentrated all of their money in one company. They were the CEOs. They might have founded the company. Think about Bezos or Elon Musk. You hear all about that. You don't hear about all the people who lost their wealth because they had it all in one basket.
Yeah, and I think that's that I guess is maybe the disservice here is that just the kind of media ecosystem that we live in always captures and highlights the successes.
Yeah.
That's what attracts a lot of eyeballs.
It's the myopic focus on winners. Now, I like positive news too, but we have to keep it real, right? To give people that peace of mind. Now, we can't give people peace of mind according to regulators, but, you know, it's really about confidence. What is going to give you the highest probability of being able to live the way that you want to live? That's what really matters.
Yeah, and I think, you know, from our perspective, it's a little different. So, you know, to your point, while in the media, magazines and so forth, you're really getting a very skewed view of the rare but the incredible success stories that are out there. But you know, as our role in our day-to-day life and our fiduciary responsibility, which is to allocate capital, to allocate people's life savings, what you realize is that, you know, what you see, you know, out there in the press is that it obscures the statistical reality that there are an incredible amount of failures that exist, just not in, say, the economy, but also in the public stock markets where we operate. And that's why there's such an emphasis on diversification and reducing or mitigating risk where we can, because ultimately, you know, somebody works their entire life. We have to make sure that we're deploying their investments in a responsible manner.
Right. You know, we all know about the statistics about businesses and the probability that a business is going to succeed after 5 years. It's really low, right? And then to succeed through generations, through many, many decades, it is very, very improbable that a business is going to succeed. And I think what we learned this week was Hendrik Bessembinder, I can't pronounce his name, so he updated his research from 2016 and went back for 100 years. So why don't you highlight some of the things that came out of that study?
Yeah, so just to go back one step there, you know, if you think about private businesses, you know, America is really kind of founded on the spirit of entrepreneurialism. And you're right, you know, the Bureau of Labor Statistics tracks this data, but, you know, any kind of new enterprise usually has an 80% success rate after a year. But when you get to 5 years, right, it's about 50%.
50% fail.
Yep. And when you get to 10 years, only about 35% of businesses succeed, about 65% fail. But the reality is, you know, it's a competitive environment that we exist in. But those statistics, you know, more or less are reflected in the public market for common stock. So that's where, to your point, Hendrik Bessenbinder, who I believe is a professor at Arizona State University. So he put out this study in 2016, and he has periodically updated it. But the anchoring point is 1926. So now conveniently we have 100 years of data, which 100 years seems like a big enough sample size, I guess, to draw
We've been through enough.
Yeah, to draw some reasonable conclusions.
Exactly.
But that study, I think, kind of mirrors the statistics you would see from the Bureau of Labor Statistics, and, you know, for private businesses, is that 60% of the stocks that have existed over this 100-year period of time have been net wealth destroyers, where essentially
that's incredible.
They have,
so
lost
here
value.
You were willing to invest for the long term, quote unquote, right? And you lost money 60% of the time in the in individual stocks. But yet we hear about what the stock market does over time. So what's going on there? Are the winners just outperforming by such a grand margin to over you know, to, and that I think is the real takeaway from all this.
Yeah, and I think you kind of hit the nail on the head there, which is that there is a significant population of firms that lose money. But the reality is most of the incredible wealth creation that we've seen in the U.S. Equity markets over the last 100 years has come from a very narrow subset of just extreme winners. And there's some really interesting statistics. There's actually, if you look up the study, which you can find online, go to page 25. It's the very last page in the study, and it gives you this great summary table that you can find there. But the statistic that really jumps out to me, Patti, is that, you know, the U.S. market has created about, I think it's like $91 trillion of wealth.
Trillion.
It's a big number.
Yes.
Half of that wealth has come from 46 companies out of 29,000.
29,000. So that is far less than 1%. Like, it is a fraction. It's like 1/10 of 1%, right?
Well, actually, in the table, it says 0.158%.
No way. How's that?
So it's a really small amount, but it just gets back to this point, like whether you think about just the market for private businesses or even the publicly traded businesses that you can buy in the stock market, is that, you know, ultimately, while investment in a broad portfolio of businesses is a good long-term strategy and can create a lot of wealth, trying to cherry pick,
oh my goodness,
you know, the odds are just so dramatically stacked against you that you're going to find the right one over the right period of time. Because again, markets are competitive, you know. But to your point, again, it is a very small population of just extreme winners that drives most of the wealth creation. So in statistical parlance, it just has this extreme positive skew. It's just a lot of really outliers that just drive most of the gains.
And good luck picking which ones are going to be the outliers in the future, right?
Yeah, well, go back to the 50s, like the Nifty 50 stocks, and think about, Xerox
and
or
IBM,
Polaroid.
Right, all those companies,
The market is creative destruction. You know, only very few of those companies ever stood the test of time. So there are periods of time where they're great, but are they great over 50, 60, 100 years? So yeah, but I think in our case, you know, where we tend to deal in concentration risk, because there's some concentrated risk people can't avoid, like people who are business owners. Right. A lot of their wealth is concentrated there. I think where our focus is the people that own stock in employers, publicly traded employers, where there is a liquid mechanism to divest that stock.
So let's address that, Eric. Why do people hold on to large positions?
Yeah, and it's complicated.
Yeah.
I think a lot of it, to some extent, is kind of the human
Sentimental, right.
psychology.
Mm-hmm. Yep.
I think you've got a great story. That's
Oh,
just
I
thinking
do.
about, your history.
When I first started as a financial planner, the first financial plan that I did, that the firm that I worked for in Philadelphia, they said, okay, you're going to do a financial plan on you and your husband. So it was a wonderful experience because I understood how people might feel, because Ed and I were driving into Philadelphia, and he said to me, "What do you think they're going to tell us?" And I said, "I don't know. I'm not allowed to be involved in that." So we go to the meeting, and they're making the presentation of what the recommendations are, and one of the recommendations they made to Ed and I, Eric, was we would recommend that you sell your IBM stock. We had 100 shares at the time. And I looked at the principal of the firm and I said, well, I don't want to do that. And he said, what do you mean you don't want to do it? At the time, and maybe even today, there are people who kind of think that they know everything and you should just do what I say. Well, I didn't want to do what he said. And he said, well, why not? And I said, you know what? For whatever it's worth, you didn't ask us a really important question. And he said, what's that? I said, do you have any sentimental attachment to this IBM stock? And the answer is yes. My dad worked for IBM. I'm an IBM baby. Everything, we had the Think pencils. He was, with IBM, we had all the gear and everything like that. And I said, when Ed and I got married, we got 100 shares of IBM stock. I don't want to sell it because we have a sentimental attachment to it.
Yeah.
And at that point, the owner of the firm was like, okay.
Yeah.
And from then on, they started to ask that question. Now, one of the things that we do here, Eric, that I also think is important is we need to save clients from themselves.
Right.
Sometimes. Sometimes when you have a sentimental attachment, if you're taking on too much risk than you can afford, that's not okay. Mm-hmm. Another story, I had a client who worked for a pharmaceutical company. This was before your time even, and they had a lot of money in the one stock where he worked. And so he believed in this company. He loved this company, yada, 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 in spite of the fact that he had been downsized. So I said, okay, let me run the numbers. And I ran the numbers and I said, what if this stock goes to zero? Mm-hmm. Do you have enough other assets so that you wouldn't be in financial ruin? Because that's what we're trying to avoid. Avoid financial ruin by having all of your eggs in one basket. Mm-hmm. I ran the numbers. They were going to be fine. So we held on to the stock and we did some other things to get that, a synthetic dividend, things of that nature.
Yeah, to diversify around it. And I think too, just for the people that are listening today, when we define concentration,
Yes.
Is this a black and white thing? Where do you how do you define that? And I think generally anything that is above 5% of the portfolio, and to your point, what if it goes to zero? What if it suffers a catastrophic loss? Right. Because again, when you look out over the data, many, many stocks suffer catastrophic losses that they do not recover from. So what if that were to happen? But I think in our case, we see a lot of people where it's 20%, 50% of their balance sheet is tied up in this enterprise, and that's where
scary.
the risk,
that gets crazy. Yes,
is real. But I think back to the point of you had the story. Certainly there can be sentiment. A connection to a parent because of an inheritance. Yeah. I think for a lot of people too, where they've experienced a significant success, where their life has been changed financially because of the growth of this stock. I think there is kind of a representative bias there, and is this no matter how irrational it might be, is to kind of take the past success and just extrapolate it into the future.
It's going to keep going. Yep.
Yeah, so like the old saying there is, assuming it won't rain tomorrow because it didn't rain last week is a good way to get soaked. So having a hot stock, assuming that it's just going to keep going up, is a good way to see.
What I think is so fascinating is that most of the stocks suffering catastrophic losses were valued at reasonable price earnings multiples. Mm-hmm. So even the pros, look at private equity, for example, that we have clients who have made private investments and lost all of their money. It's really hard to own a business in this competitive environment and succeed over 5 years, over 10 years, over your investing lifetime. Mm-hmm. Why take on that risk if you don't have to?
Yeah, precisely. And I think, part of it is again that past experience is a
Right.
predictor of
Yes.
what the future pathway will be.
And
And
I
yeah,
think the other thing is people buy into the stories. It's
yes.
all about the story, right? What was it that made the stock go up and up and up, and why do you think it's going to continue to go? And I think you're one example with Fiserv. It was up 11 straight years. Unbelievable growth, right? It peaked in the first quarter of last year at $238 a share. It had a compounded return over those 11 years of 11%. Of course, somebody's going to buy into that story and say it's a great company, only to find themselves owning a stock today that is worth $56 or a 76% drawdown,
Yep.
right?
Yep.
So what's really interesting, and we have it here later, but what is it that makes stocks go down so fast? I mean, it's fast. You think
Yeah.
about Novidisk, right? Nordisk, the maker of Ozempic, right? The wonderful drug that's changing the lives of so many people, helping their hearts, helping them manage their weight, etc. And the stock went up and up and up, and it was great. It was great. The story was working, and then it lost 71%, even
Yeah.
though people are still using it.
And I think, the tough part is, all of these companies have a story, and that story is told through the financial statements. So when you're, if you're someone who enjoys, and there's not many people out there, but
Right.
someone who enjoys reading an income statement or a balance sheet or a statement of cash flows, in a lot of cases, that story is incredible in
Yeah.
terms of just the success and the metrics that you would look at. But to your point, the ground, especially in the public markets, the ground shifts
So quickly.
very quickly, right? Sentiment can change on a dime. And if you think about it, the mechanics here are not all that complicated. Essentially, any investment, whether it was a bond, a private business, or even a stock, is essentially worth the sum of its future cash flows adjusted by the risk. Okay. But something can come along in the news or whatever. And what happens there in terms of the stock's price, the cash flows get readjusted down, and the assumption of risk that is assigned goes up.
Look what
and
happened to
that-
Boeing, right?
Right.
Who could have predicted that the door was going to blow off and the stock lost so much money as a result?
Yeah.
That's an example of, something that comes out of the blue that nobody could ever predict or anticipate, and it really affects people's wealth.
Yep. Yeah, exactly. And that's the part too, especially in the market for publicly traded stocks, is liquidity. Liquidity is a great thing unless bad news comes out, because that's why you
Exactly.
tend to see that
Right.
really exaggerated decline in value.
It's like riding an elevator and they snap the cables and it just goes straight down,
Yep.
right? That's like investing in general. It's like it's more like an escalator over time, but then when it goes down, it's like you're in the elevator and the cable snap.
Yeah, I think that's what they call in trading terms a gap down, because it will close at one price and the next morning
Huh.
it opens up.
Oh, I've never heard of that term.
20% lower.
Eric, I learned something new every day with you.
Well, it's always
Gap
fun,
down.
right? The journey
Yes,
never
it is.
ends.
So it never ends. Okay, so
right.
here's something we hear an awful lot.
Yeah.
I don't want to pay the capital gain. So let's talk about the tax cost. You have an example here of Apple. Okay,
Yep.
so let's say that somebody put in $200,000 into Apple, right? And let's assume in this example that it's worth $2 million. There's $1.8 million in capital gains. Why would anybody want to sell that? Why should they sell it?
Yeah, and I think here, again, the other reason beyond just this representative bias, just to assume, well,
It'll
the stock's
continue.
done so well,
Yes.
it's going to keep doing well. This perpetuation of success. Taxes, I think, to your point, are the other main reason, is that people just don't want to. They don't want
wanna
to settle
pay
up
it,
with
right.
Uncle Sam. But
Yep.
you have to think in Apple, at least in this example. This is what Peter Lynch would have called a 10-bagger.
Yeah.
You made 10 times your investment. You put in 200,000. It's it's now worth $2 million. But there's this huge tax. But when you think about the tax, the reality is also consider the volatility of the stock. And individual stocks are extremely volatile. And if you've been on, for most people who've made a lot of money in a particular stock, it's because they've been on the favorable side
Right.
of the volatility, but it can go both ways. So if you think about the tax cost, how much would it cost me to sell the entire position? And usually it's a big number, and that
That's a killer, right?
That's usually
Mm-hmm.
induces some stomach acid. But just consider that that tax cost of selling that stock, might be 15 or 20% of the position. Well, guess what? If you look at Apple historically, it has experienced drawdowns. While the stock has gone up, it has experienced drawdowns. 2 drawdowns of 79%.
Yeah,
throughout its lifetime.
79%.
Right. So
Crazy.
What you tend to see in a lot of these stocks is when the tide turns,
it's fast.
Stocks go down 30, 40, 50%.
And you're going to look back. Talk about regret, right? Look back and say, gee, I wish I would have sold it and paid the taxes.
Yep.
In this example, the tax bill is $483,000.
Yep.
And we did this you did this calculation. I take no credit for it. It's Eric, of course. Close to 27%, a blended tax rate. And we live in Pennsylvania, so you did this at assuming the 20%, capital gains rate, 3.8%, all the taxes that are involved. That's close to $500,000. But you still kept $1.5 million.
Yep.
Kept 75% of it. And instead of having to gut it out and live through these drawdowns of anywhere, the best drawdown, I know that's an oxymoron, but the best drawdown was minus 24%. How ironic is that? That you might as well just go ahead and pay the taxes and not expose yourself to that kind of drawdown.
Yeah, and I think that the trick there is too is that, when you think about it, the tax bill is usually nowhere near as bad as some of the drawdowns. But if the stock declines, now you're in this position where you're saying, well, how can I sell it now? Right.
Right. Exactly.
I've got to get back to where
I
the
got
prior
it right.
point
Exactly.
is. And then
Again,
it just
another-
perpetuates, and then
Yeah.
you don't sell, and
Yeah.
potentially keeps going down. But I
Okay,
think,
what do we do in those situations? I'm gonna play
Yep.
where it's Apple. It's gonna come back. It always does. So it certainly could. It's not like the net amount isn't going to be making money in a diversified portfolio. You'll still be making money. It'll be hopefully much more diversified and have less risk of significant drawdowns.
Yeah, I think there, again, it depends on each person, but I think, my thing would be is ultimately, listen, we have to admit here that nobody knows
Yes.
what's going to happen.
Yeah.
You, I,
Sure.
or anybody
Yep.
can predict the future. And I think we just have to use prudent risk management, which is to say, listen, look at the overall picture of our net worth. Let's at least agree to start gradually reducing the
right.
position, gradually scaling back
Sure.
and taking some out. And I think that the hardest step is the first step.
It is.
But once you get there, then I think it becomes easier. But
You have
anyway,
a-
sorry.
You have a
continue.
plan. You have a strategy.
Yes.
And we lay out the strategy and say, this is going to mitigate the risk and reduce the amount of pain that you're going to feel all at once.
Yep.
And there are ways to do that. We're going to go through that.
Yep.
So,
But I think too, the other part about taxes that I think from a historical perspective, taxes came about, I think, with an amendment in 1913.
here is our history buff, right?
Right.
Eric is our professor. He should be a history professor. So tell us, Professor.
Well, I think history is always a great teacher,
Yeah.
or at least provides context. But if you think about our tax code and the way it taxes income, if you buy a stock and you make a lot of money in that stock, the best possible way to make money in the tax code is through investment, because the tax code has always offered preferential rates on capital and much, much higher rates on income from labor.
Yep.
Just think about it. If you made $500,000, you're paying the 35 to 37% tax rate. Capital gains tax are, I believe, 15% up
Right.
to about $600,000.
Exactly.
So, if you're making, the best way you can possibly make money is through investments, and the tax code gives you a pretty fantastic deal.
Right.
compared
And
to if that
it's a
money was
great
earned through labor.
incentive.
Yeah.
Not only can you invest in your capital in real investments, in real companies, because remember, that's what we're investing in. These are diverse companies throughout the world, literally, in the United States and Europe and, all over the place. And some of them are going to work out really, really well, and some of them are not.
Yep.
That's okay. You're still going to do fine over time. Maybe not every time, but over time.
Right.
And that's the beauty of asset allocation, allocating that capital according to what's okay and what you need it to do for you. Because your money's a means to an end.
Yep.
Right? So
we want to make sure it lasts to the end.
exactly.
That's
exactly.
the most important
Knock
part.
on wood, we've never failed at that.
Yep.
So
But I think, the point is once we can get to the a point of consensus where, like, yes, it's a risk. We're open to the idea of approaching this, I think, in a strategic way.
yeah, let's
in
be
a thoughtful
strategic.
way. Because listen, we're all about, to the extent that we can, minimizing tax or finding the best solution to create the best tax outcome. And I think that's where we're really considering different tax lot
Right.
methodologies.
4 methodologies.
Yes.
We've got LIFO. Why don't you explain the 4 methodologies?
Yeah, so if we're going to sell the stock, and usually it never happens all at once, it's something that's gradual,
done over time.
over time in a lot of cases. But it depends on how you acquired that stock. Most people acquired the stock over time with a series of purchases, which means that you acquired the stock at a different cost basis along the way. So if our goal is to, address the risk, we want to try and create the most dollars for the least amount of tax, or at least that would be the optimal way to do it. So when you go to sell shares, if you're going to put it in order, let's say for 100 or 1,000 shares, whatever it is, how do we select the methodology that will create the greatest amount of dollars with the least amount of tax? So if it's a rising stock over time, last in, first out.
Yeah, LIFO.
Sell the most recently acquired shares that are likely to have the highest basis because the
Yeah.
stock's rising, and that's a way to do it. Or you can use specific identification. So that's where you're literally just cherry picking the best and most favorable lots, which is a great way to do that. Or they have these various optimization things where you don't really have to do the thinking. You can just say, max loss, minimum tax. So if there's any lots with a loss, those will get sold, and then it will start prioritizing the lots that have the most favorable basis. So you don't have to do all the thinking. The trading software will do it for you there. But, that's a very thoughtful approach to scaling out and trying to get the best
because
tax
not
outcome for the
every share is
individual.
going to have a huge gain. So you
It's
want
true.
to pick the most favorable shares to sell, and some of them are going to be sold at a loss to offset some of the gains.
Yeah. And I think the only other thing here too, especially with concentrated positions, not to get morbid, but it is to think about mortality risk.
Yeah.
If you have somebody that bought ExxonMobil in the 60s or 70s, and now they're in their late 80s, there is that step up in basis. So I think before you do anything here, you have to weigh somebody's cash flow needs, but also the mortality risk, because that step up in basis is an incredibly powerful way to pass that wealth on to the next generation without the embedded tax. So again, it gets complicated.
Sure. It would be nice for you to gift those shares to your family, to your children and grandchildren. The problem is that when you do a gift, they take on your original cost basis, so it doesn't get the step up in basis benefit.
Precisely.
So, and that's true for trusts as well. We do a lot of estate planning here. So it's really important to understand what the overall goal is and understand how we can reduce your risk and optimize your financial affairs in every area, not just the portfolio, but also your cash flow. Minimize your taxes and look at your estate plan and figure out what you want to do for your family, your loved ones.
Yep. Yeah, exactly. And again, this is, that's why holistic financial planning, I think, is so important. Because yes, the stock is an issue and it's a part of your portfolio, but what is the broader picture? What are the legacy goals?
Well, sure. Let's talk about that person who acquired the stock when they were working for the company. They're now retired. The stock is in their name. It's held at some, clearing firm or whatever. It's in their name alone. For that person, if they really wanted to hold on to it, I would say that's fine. Here's the deal. It's really important that you let us know if anybody gets a diagnosis, because how an account is titled, how that stock is titled, is really, really important. So that's when we really get to work, to be really thoughtful and really understand clients, what they want to have happen, understand what the gain is, and really optimize their financial affairs.
The following presentation is sponsored by Key Financial Incorporated. The Patti Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patti Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patti Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRA-SIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.